Okay, right. The next thing I want to talk about. So I've talked about depreciation. I mean, the same thing applies to losses on sale of assets in effect, because with losses on sale of assets, you have exactly the same thing happening. I'm just going to come back to my 200 that I was talking about here. So that was the cash. That was my cash movement in cash in the bank, because that's what I'm asking for. What's the change? And this was my profit. Profit has changed from 0 to 200. Imagine you had a loss on sale of anything. Any loss, when you calculate your disposal, you have a loss. That loss reduces your profit, for example. Imagine that was a loss of 50. That doesn't hit the bank. The loss itself doesn't hit the bank. Right? This is just it's an accounting loss. I need to add that back in the same way I'd get 150. This was a loss. I would add that loss back. Add back the loss to get me back. In the same way, this could have been a gain. If this was a gain of 50, you would have 250. If it was a gain, I would deduct that gain, if you like, from my operating profit to get back to the cash flow from operations. So I've done three things there already. I've told you that we add back depreciation, we add back losses on sale of asset, right? And we deduct gain on sale to come back to the original 200, right? And I've shown you that. I mean, a loss, of course, is on disposal, right? Imagine remember you would have here, you have an asset, say, that was worth 100, and if you sell it for 50, you've made a loss. So how do we do that? We credit this side and we take the gain. Sorry, we take that loss as an expense of 50, and that's how we have that 50 showing in our income statement. That's that 50 over there when it's a loss, right? Making it 150, 200 minus 50. So it's in our income statement, but we need to kind of add it back because I'm trying to get back to my cash position. Right. So that's those three elements there. So we've dealt with three elements there: one, depreciation; loss on sale; and gain on sale. Okay. Right. Let's look at the next points, which are very interesting, actually. Really interesting points, really. Let's talk about trade receivables. Now, let me ask you a question. Look at this. Look at this scenario over here. This is important. Imagine you sell goods for, and I want to show you via double entry first, and then I'll show you by how we just talk about it. Imagine you sell some goods for £10,000, if you like. Yeah, and then I have here, or let me put it like this. Actually, because I'm not even sure how I'm going to sort of show this, but let's just say I have an opening balance, yes, of 10,000 here. And here I have a closing balance of, I'll do both. I have a closing balance here of, I don't know, £2,000. £2,000. Yes, let's do it this way. Now, I'll talk about how we do it quickly, but what does this really mean? If I have 10,000 here and I have 2,000 here, let me make this up, and it could be anything, so you can see what happens here. You can pick any number you like. So I start my year with 10,000. Let's just say, I'm just going to be random. Let's just say I sold goods for. You pick any number you like. This is what you're given in the account. So for example, you would see something like this: 2005, 10,000, 2006, 2,000, if you like. So the opening balance at the beginning of the year of 2006 is 10,000. The closing balance is 2,000. This is what you're seeing, right? So this is trade receivable. The question is, what does this really mean? Pick any number you like. I don't care. Here's my revenue. You sell goods for 28,000. I'll be as random as that. You sell goods on credit for 28,000. 28,000. Now here's the thing. If I ask you, right, how much you received in the bank, well, 100% you're going to tell me, well, Oyen, you must have received, this is 38,000. You must have received 36,000. That's what you're going to tell me, right? Because that's the only way this is going to balance. It doesn't matter what two figures you pick. The difference between these two figures will be the same difference between these two figures, 8,000. They just will be. There's nothing you can. I picked total random numbers. We can try again. I'll pick. Don't know. Doesn't matter. 50,000. If I pick 50,000, just get my eraser out. This becomes. Oops, sorry. This becomes 60,000. This becomes 60,000. So this must have been 58,000. The key point here is that if I'm adjusting my profit for the year, so remember your profit for the year has your revenue figure in there. This is important. Your profit for the year, to get profit for the year, you must have included, you can see you'd have had here in your profit for the year, you'd have had revenue, right? Because remember, I'm just reconciling. I'm starting off with my profit for the year. I'd have had 50,000. If I'm trying to get profit for the year to include what cash actually came in, well, if I know my profit for the year already has 50,000, because that's what it is, debit, trade, receivable, credit, revenue, that's profit for the year, I just need to top it up with the extra 8,000, right? So that's the adjustment. And I say, well, if the cash that came in was actually 58,000. I already have 50,000 in that idea of profit for the year. I'm just topping it up with 8,000. That's the principle. That's the core original thinking process here. It could have gone the other way around. It could have been the other way where this could have been. So anyway, so we then say things like this. Well, I mean, people say that, oh, well, if you had 10,000 at the beginning of the year and you have 2,000 at the end of the year, it means that 8,000 came in, which kind of makes sense as well. Because imagine if you think about if nothing had happened, let's just change this. Imagine nothing had happened actually during the whole year. Well, it does simply mean that it really, in truth, you could argue it that way, that, well, it means you must have received 8,000 in the year, bank 8,000. And then you just bring these back down to 10,000. So the key point here is that people say, well, 8,000 came in, so we just add the 8,000 to your, if you had your profit for the year, you had, well, when I'm doing my thing, I do operational profit, add depreciation, add loss on sale of asset, deduct gain, add any. So we basically say when trade receivable falls, we add the difference. So in this case, trade receivables gone from 10 to 2, so we add the 8. But it's not magic. We're not making it up. It's true. It's because the real thing is what I showed you here earlier. That's what I'm doing. I'm really adjusting for that change. But we just say when we have a fall, it's as though it went from 10 to 2, so you had 8 coming in. But I've shown you the theory. So I've shown you the theory of how we actually arrive there. Let me just flick this and treat it as though it was the other way around. Imagine you had this. Imagine this time you had a scenario where you had 2, and this is now 10. Well, let's do it. Let's just say you sold goods of 50,000 in the year. Here we have income, 50,000. Well, the only way this can balance, this is 52, is for this to be 42. And this is now 52. So what this means is that, yes, you sold goods on credit for 50, but only 42,000 of cash came in. My operational profit right now includes 50,000. So if I want to bring this down to 42, because that's what I'm trying to do, I'm trying to reconcile, I need to take away 8. Right? So what you see in your balance sheets is 2005, 2000, 2005, 2000, year 2006, 10,000. So we say that, well, when this goes up, it's as though you've lost money, like you've extended credit. But the point, this is the theoretical point here of what's really happening. I picked any 2 random numbers. You can pick any numbers you like, any random numbers you like. So the point is as though money went out. But in effect, what we're really doing is reconciling that initial profit figure and reducing it by that 8 to bring it, because I'm trying to arrive at the cash figure. I'm trying to arrive at the cash that actually came in, because I know what the profit is, right? And that's how the reconciliation works. Great stuff. So this is trade receivable, and what I'll do in the next video is show you the theory behind. So now you can comfortably move. If you see trade receivable increasing or decreasing, you know what to do. So when trade receivable increases, think of it that way. That's a good way to always do it as well. When trade receivable decreases from one year to the next, so for example 2005 to 2006, where it goes down, so for example like the 10,000 to 2,000, well, it means we've received money, so cash has come in. But I've shown you the theory. When it goes up from 2 to 10, it's as though money has gone out. So we deduct, right? It's as though money has gone out. We've offered credit. Awesome. Okay, great stuff. I'll see you in the next video where I tackle trade payables.